If you keep more than a certain amount of money sitting in one ordinary checking or savings account, something is quietly working against you right now. And the bank that holds your money has no reason in the world to warn you about it. In fact, it quietly profits from your silence. Because the moment your money crosses a certain line, three separate things begin happening to it at the very same time. The first one is slowly shrinking it, month after month, without a single number on your statement ever changing. The second one leaves a large part of it completely unprotected, so that if your bank ever failed, and banks do fail, you could simply lose it. And the third one, the most dangerous of the three, can put a freeze on your account or a federal report with your name on it over a completely innocent move that millions of careful, honest seniors make every single month without ever realizing it can be treated as a crime. You did nothing wrong. You stole nothing. You broke no rule you would even recognize as a rule. But the system does not care about that. It only sees the pattern, and the pattern is what it acts on. I went through the federal banking rules, the deposit insurance limits, and the reporting laws that most people over 60 have never once had explained to them in plain English. And I am going to give you three things, clearly and simply. The exact line where your own money quietly starts working against you. The three hidden dangers of leaving more than that sitting in a normal account. And then the specific, completely legal ways that careful retirees keep their money safe, protected, and finally earning something instead of sitting still and exposed. One of these three is going to surprise you because the innocent little thing people do to avoid it is the exact thing that gets them into trouble. Let me start with the danger that is the easiest of all to miss because it happens so slowly that you never once feel it. The first danger is the quiet one. And it is already happening to almost everyone watching this. Money that simply sits in a regular checking account or in a basic savings account paying you almost nothing is not standing still. It is shrinking. Every year, the cost of everything you buy climbs a little higher. Your groceries, your medicine, your electric bill, your property taxes. You do not need anyone to name it for you. You feel it every time you stand at the register, and the total is higher than it used to be for less in the bag. Now here is the part that matters, and it is the part the bank will never say out loud. If your money is earning almost nothing, while the world around it gets more expensive every year, then the real value of that money, what it can actually buy, is falling steadily, month after month, even though the number on your statement never moves. $10,000 left untouched in a no-interest account does not stay $10,000 in any way that actually matters. In buying power, a few short years from now, it is worth noticeably less than it is today. And the bank is perfectly content to let it sit there, because while it sits, they are lending your money out and earning on it, and handing you back almost nothing for the privilege. So this first danger is not loud. There is no freeze, no letter, no knock at the door. It is just a slow, silent leak in the bottom of the bucket. And the more you keep in that account, the bigger the leak grows. Do not comfort yourself with the idea that a tiny bit of interest fixes this either. If your account pays you a fraction of 1%, while prices climb several percent a year, you are still losing ground every single month. The only real question is how fast. The second danger is the one that can turn a lifetime of careful saving into a gamble you never agreed to take. There is a federal insurance program run by an agency known as the FDIC. And it protects the money you keep in a bank if that bank should ever fail. And most seniors assume, very reasonably, that all of their money is fully covered. It is not. That protection stops at a line. As of right now, that line is $250,000 for each person at each bank in each ownership category. And here is the part almost no one is told. Every single dollar you keep in one bank above that line is not insured. It is exposed. If that bank were to fail, the insured money comes back to you quickly and completely. But the money sitting above the line becomes something you can only hope to recover from whatever is left behind. And you might get some of it, or you might get none of it. Now picture a couple who sold their home, or received an inheritance, or spent 40 patient years building a nest egg, and placed all of it into one account at one bank, because keeping it together in one place simply felt safe. The very thing they did to feel safe is the thing that quietly left a large part of their life savings uninsured. And their bank had no obligation whatsoever to warn them, because sitting above the line breaks no rule at all. It is simply your risk to carry silently, whether you understand you are carrying it or not. And what makes this one worse is that almost no one ever checks. They see one big, reassuring number on the statement and assume the entire thing is protected. The right day to find out where your money sits against that line is a calm afternoon this week, not the morning the news says your bank is in trouble. And now the third danger, the one I promised would surprise you. Because the trap is not in having the money at all, it is in how you move it. For more than 50 years, there has been a federal law that requires your bank to file a report with the government anytime you move more than $10,000 in cash in a single day. Not because you did anything wrong. It is completely automatic. A cash deposit, a cash withdrawal. Any movement of physical currency over that $10,000 line, and a report is quietly filed with your name on it. Now, that report by itself is not a crime, and it is nothing at all to fear if your money is honest, which for nearly everyone watching this, it is. But here is exactly where good, careful people walk straight into trouble without ever meaning to. Someone hears about that $10,000 line, and they decide to be clever and careful. So instead of depositing $12,000 at once, they bring in $6,000 one day and $6,000 a few days later, just to stay under the line and avoid the paperwork and the attention. That feels careful, it feels private, it feels responsible, and it is also, under federal law, a crime. It even has a name. It is called structuring. And it is illegal whether or not the money was earned in the most honest way imaginable. Deliberately breaking a deposit into smaller pieces to stay under that reporting line can carry very serious penalties, including heavy fines and even prison time. Because the law treats the act of hiding the transaction as the offense all on its own, completely separate from where the money actually came from. So the single most dangerous mistake in this entire video is the one that feels the very safest. Trying to quietly slip under the radar is the exact thing that puts you on it. Honest people have had their accounts frozen and their money seized over this. Not because they were criminals, but because the pattern looked like hiding. And the pattern is all the system sees. So what do careful retirees actually do about all three? Not the wealthy with teams of advisors, just ordinary people who took a little time to learn this before it cost them. The answer to all three dangers turns out to be one single idea. Do not let large amounts of money sit still, exposed, and idle in one ordinary account. For the insurance danger, you spread it. Because the protection is counted for each bank and for each ownership category, the same money split across 2 or 3 banks can be made completely insured instead of partly exposed. And even within one single bank, different ownership categories each carry their own separate protection. An account in your name alone, a joint account with your spouse, a retirement account, and a properly set up trust account naming your loved ones. Each one can carry its own coverage, so that a careful arrangement protects far more than that single $250,000 line ever could. For the shrinking danger, money you do not need for your day-to-day living does not belong in a no-interest account at all. There are options that are still completely safe, and still federally insured or federally backed, like a money market account, a certificate of deposit, or United States Treasury products that will protect your money and let it earn at the very same time, instead of quietly bleeding value while it sits. And for the reporting trap, the rule that keeps you perfectly safe is beautifully simple. Never, ever break up a deposit or a withdrawal to slide under a line. If you are moving a large sum honestly, move it in the open, all at once. Let the ordinary report be filed without a second thought, and you have absolutely nothing to fear. The only people that law is built to catch are the ones trying to hide. So simply never look like you are hiding. And please, do not treat any of this as something you arrange one time and then forget forever. Interest rates change, insurance categories get quietly misunderstood, and the single most common way honest people still get flagged is by getting clever with one large transfer, years after they were sure they understood all the rules. So on the very day you rearrange your money, write down plainly how each piece is protected and why, and then look at it again once every year. Because the people who end up lying awake over this are almost never the ones who did something wrong. They are the ones who did something quietly and never stopped to check whether quiet and legal were actually the same thing. Step back for a moment and look at the shape of all three together. Your money, sitting in one ordinary account, is quietly shrinking. partly unprotected, and one innocent-looking move away from a federal report with your name on it. And not one part of that is because you did anything wrong. It is because the system is built to keep running in the background whether you are paying attention or not. And the bank that holds your money has no reason at all to stop and explain any of it to you, because every piece of it works quietly in their favor and against yours. But every single one of these dangers has a calm, simple, completely legal answer. And now you know what all three of them are. So here is the one thing I am asking you to do. Sometime this week, look honestly at how much you are keeping in one account at one bank and ask yourself two plain questions. Is any of my money sitting above the insured line, unprotected? And is the money I do not need right now quietly losing its value while it sits there earning nothing? And then think of one person you love, a parent, a neighbor, a friend, who worked and saved their whole life and keeps every dollar of it in one place because no one ever once told them there was any risk in that at all. Send this to them today. It may be the one thing that keeps their savings safe, whole, and growing, instead of exposed and shrinking for the rest of their life. One honest word before you go. The insurance limits, the reporting rules, and the safest places to keep your money can all change over time, and no two people are in exactly the same situation. So please, take this as the push to go look closely at your own accounts, and not as personal financial or legal advice. A few quiet minutes with your bank, or with someone you trust who has no reason at all to profit from where your money sits, can tell you exactly where you stand. None of this is worth losing a night of sleep over. It is worth one calm afternoon of checking before another year slips by with your money quietly working for everyone except the person who earned it.